Hey guys, my name is Jose, and this is another episode of Buy or Pass. In this series, I will look at the financial documents of a company and decide if I had money, would I buy or would I pass. Before we start, don't forget to subscribe to get info on new episodes and other videos. So let's begin. So, like always, I'm gonna use the website known as lazyfa.com, which allows me to see all this financial information in a more visual format, charts and graphs. So today, the company for today is gonna be Nike, ticker NKE. So let's be lazy. So here we're gonna start off with the income statement. In the income statement, we're gonna look at revenue, cost of revenue, gross profit, and net income. All right. So revenue from 17 to 18, we can see has increased the past year. 17 was about 34.35 billion. 18 was 36.4 billion. So close to $2 billion increase of revenue. A little less than 10%, about probably 66 or 70% increase in revenue. 6%, sorry, not 66, about 6% increase in revenue. Not that crazy. We can see cost of revenue is also increasing. Last year it was 19.4 billion. This year was 20.4 billion, an increase about 1 billion, $1 billion in for cost of revenue. Gross profit has also increased, but it does look like it's been plateauing the past 3 years. 16 was 14.97 billion, 17 was 15.3 billion, and this year was 15.9 billion. So it doesn't seem like the gross profit itself has increased dramatically. One thing that I'm looking right here, that's net income. And the net income 17 and 18 dropped dramatically. So normally its net income of last year was $4.2 billion. This year was $1.9 billion. It cut its income by more than 0.5%, which is pretty crazy to see. So net income is the money it's collected after paying people, after its gross profit, taxes, and stuff, and other, etc. Earnings per basic share, again, is dropped down. You can see the net income $1.19 per basic share. So its earnings are not as strong compared to other years. So looking at this income statement, it's looking right now like a pass. Let's take a look at Lazy FA red flags, which is just another way for us to see this. So again, we're still in this income statement. Let's take a look at revenue versus cost. Here we can see obviously revenue is a lot higher compared to cost of revenue. So, all right, that's why we see gross profit increase. Yes, this year was about 16 billion dollars worth of gross profit, and last year was 15.3. So that's a good thing to see, right? That revenue being so low compared to its cost of revenue. Here, we're also seeing that percentage growth. So this is not numerical growth, this is percentage growth. So this year, the revenue growth grew about 6%. Cost of revenue grew about 7.3%. So it's pretty. I'm not liking it that its cost of revenue is increasing at a higher rate than its revenue. So again, looking at based on income statement, this would be a pass. Luckily, we have other statements to take a look at, and now we're gonna take a look at the balance sheet. So in the balance sheet, we're gonna see the assets, liabilities, total debt, and cash equivalents. All right. So here, total assets. From 17 to 18, we had a decrease in total assets. 17 had assets of about 23.26 billion, where now is 22.5 billion. So close to about $700 million, around there, around that ballpark of assets lost. When its total liabilities have increased. So last year was 10 billion, 10.8 $8 billion of liabilities, and this year was $12 billion. So just in last year alone, liabilities increased by 20%, while its total assets decreased. So that's for me not looking good. Total debt, they took out. It looks like they had strong debt taken out on 17. It went up all the way to 3.8 billion compared to the year 2016, which was 2.2 billion dollars. So almost 100% increase in its total debt from 16 to 17. And 2018, there was actually a increase from 3.8 billion to 3.81 billion. So it didn't increase by much, but that total debt it has jumped a lot and it's not coming down. So that's, to me, is not looking good. Cash and cash equivalents, it has this right now. It has about $4.25 billion worth of cash and cash equivalents, which did increase between from 17, where 17 was 3.8, now in 18 is 4.2, over a 10% increase in cash and cash equivalents. That's good to know, and it's good to see that cash and cash equivalents can pay out its total debt if needed. That's good. Again, another good thing to see. For those that don't know, cash and cash equivalents are whatever the company has in cash right now, or any assets it can liquidize super fast to be collected as cash. Let's take a look at, again, the red flags. Another way to see these balance sheets, like mentioned before, assets and liabilities have increased. Liability assets decrease while liabilities increase. Not a good thing to see. Shareholder equity has decreased dramatically from last year. Last year, shareholders' equity was $12.4 billion. This year is about $9.8 billion. A little over, I want to say, about over 10% easily decrease of shareholder equity. So to me, that's not looking good. Liability itself has increased dramatically. Last year, growth liabilities increased by 19%, and this year again it increased by 17%. So 2 years in a row where it increased, its growth liability increased by double digits. Total assets this year decreased by -3%. Not good to see. Let's take a look at its asset distribution. Normally, I would see a property, plants, and equipment to be its highest percentage-wise, but here, property, plant, and equipment is 20% of its total assets. Inventory is 25%, and the next big thing is cash and cash equivalents, which is another 20%. So those three assets alone create about 65% of the business assets. I don't like that inventory is such a high asset to this company. So let's just take a look at the annual data of, I just want to look at inventory. So inventory last year, 2017, was $5.05 billion. So practically $5 billion worth of inventory, where this year was 5.26, an increase of about $200 million. So it's not increasing dramatically. It does, compared to its previous years. It looks to be at a very steady slope, but the slope doesn't look outrageously high. Looks like a normal slope. So inventory increase is not that high. But for me, even though Nike's mainly is just shoes, right? So most of the things are inventory. For their assets to be, for inventory to be such a high percentage of their assets is not a good thing to see. Here we're also going to look at liability distribution for this year, 2018. Current non-current debt is 36% of its liability. The other 35 is tax, and it's good to see its current debt. Current debt is debt that needs to be paid off in the next 12 months. Is only $342 million. this company has plenty of cash for that to not even make any scary movements on the assets. So liability. If we're talking at about the balance sheet, I don't like total assets in decreasing and liability increasing at the same time. Shareholder equity as a result has decreased. The percentage growth of liabilities these past 2 years have been about equal 17-19%, while total assets, like mentioned, has decreased. I also don't like how the asset distribution, inventory is worth 25% of that asset distribution. That to me is pretty scary. It means a lot of that, all that inventory is being held. Let's go and sell it ASAP. I want that inventory assets to be lower. I do think the only good thing I see here is its current debt is pretty low and it has a nice amount of cash and cash equivalents. But to me, this is not looking good for. I would not buy Nike at the moment right now. So finally, let's take a look at the final sheet, and that's cash flow statement. And here, the only one I really care about is net cash flows from operations, and that's positive about $5 billion, which is good to see. That means the overall company is doing good. It's collecting positive cash flow. It's actually collecting positive cash flow from investing, which is not something you normally see. But the rest of the things I don't really keep an eye on, just because companies do bad investments, or the investments are going bad, and sometimes it's good for taxes. So the only one I really care is that their cash flow of operations is doing good. But it is pretty scary to see. I'm looking at the net cash flow from financing. Normally it's capped up around 3 billion. This time it was almost $5 billion loss from financing. That's not good to see. All right, so let's just take a quick overview. Right, income statement: revenue increasing, cost of revenue is also increasing. Gross of profit looks pretty plateau for me. Net income has decreased dramatically this past year, and as a result, its earning per basic share decreased. From the balance sheet, total assets has actually decreased about 3%. Its total liabilities the past 2 years have increased by double digits of 19 and 17%. Its total debt has increased from 16 to 17 by almost 100% on 16 to 17, and it's been plateau on 2018. Cash and cash equivalents is though increasing, and it has enough cash and cash equivalents to pay off any current debt. Its current debt is only 300 million, which should be chump change for the company. Finally, cash flow is looking like positive, but at the end of the day, that inventory being 25% of its assets is pretty scary for me. So assuming that inventory is gone, the assets will be somewhere around $17 billion, and to me it's pretty low compared to its total liabilities. So for those reasons, I would vote this a pass. If I had money, I would not buy Nike right now. I hope you guys enjoyed the episode. Like I mentioned, Lazy FA makes it so easy to look at all the information, which makes these episodes go pretty fast. I'm curious, would you buy or pass on Nike based on the documents we just saw? Also, don't forget to subscribe and give me a thumbs up, and post in the comments any questions you guys have. Have a good day and see you next time.